You are watching financial news and suddenly hear GDP is growing, inflation came in hotter than expected, and PMI dropped below 50. And you're sitting there thinking, okay, should I be worried? Is this good or bad? And what does this all mean for my investment and money? Here's the good news. Once you understand these three metrics, you will read financial headlines like an investor, not a confused spectator. Today, we are breaking down these three key concepts, GDP, CPI, and PMI, in simple terms. We will cover what they are, why investors care, and how they quietly shape interest rates, stock markets, and the economy. Before I dive into the video, hi, I'm CY, and on this channel, I share more on finance and productivity. So if you enjoy this type of content, please subscribe to my channel. Now, let's dive in. When you hear GDP growth slowed, investors pay attention because slowing growth often means company profits may weaken, hiring can cool, and markets get nervous with this type of news. So, what exactly is GDP? GDP stands for Gross Domestic Product. But here's the simple versions. GDP measures the total value of everything a country produces. Imagine the economy like a giant pie. If more people are working, more stuff is being built, the more services are being used, the pie gets bigger. That's GDP growth. When GDP grows steadily, usually company earns more and business invests more. This allows unemployment to stay low as companies continue to hire and retain people. And because of that, stock markets generally like the environment. But here's the catch. A big GDP doesn't mean stock jump tomorrow. Investors care more about the direction, not size. Things like, is the economy still growing or is the momentum slowing? Now that we understand what GDP is, let's move to the next key indicators, CPI. CPI stands for Consumer Price Index, or in a simple terms, inflations. It means how much everyday life is costing over time. Things like food, rent, transport, utilities, healthcare. The usual things that people pay for. If CPI rises too fast, that's inflation, meaning your money now buys less. Your saving loses value, and people oftentimes feel squeezed. And here where it becomes really important. In the US, the Federal Reserve has what's called a dual mandate. The Fed has two key mandates, which is to keep inflation stable, and number two, to support maximum employment. So, when CPI start to climb too high, the Fed worries. Because if prices keep rising, people suffer, and the economy can overheat. To cool things down, they will raise interest rate. And this matters a lot for investors. Why? Because higher interest rate means borrowing becomes more expensive, mortgages rises, companies slow down in their investments due to higher borrowing costs, and this results to consumers spending lesser. But most importantly, when money becomes more expensive, stocks usually struggle. Because investors say, why take risk in stocks if I can now earn safer returns in bonds or savings? On the flip side, a low interest rate environment equals to cheap money, and stocks often do well. That's why CPI isn't just about prices. It's basically the indicator telling investors will the Fed raise or cut interest rates, and where money becomes tighter or cheaper. And that's why market reacts so strongly to CPI reports. Now, moving to the indicators beginners usually ignore, but professionals often watch obsessively. GDP and CPI are lagging indicators. What is crucial is leading indicators, which can inform us about the future, to a certain extent, of course. And PMI is one of the crucial leading indicators. PMI stands for Purchasing Manager Index. Instead of looking at accounting numbers, PMI is basically a monthly survey that measures business confidence. Imagine asking hundreds of factory and business managers, are things getting better, the same, or worse? The answers then turn into one simple score. Now, how to read PMI? A reading above 50 means businesses say that activity is expanding. A reading below 50 means businesses say things are slowing. Here's why it matters. PMI often moves before GDP change. So investors treat it like an early warning light. Not every dip below 50 means recession. As we overlay PMI with GDP in the same chart, what you observe is this. When PMI stays below 50 for months, especially when it drops to the low 40s, Historically, they often line up with slowdown. So when PMI falls, investors start thinking, business are nervous, orders may fall, jobs could slow. PMI shows how business feels about the future, not just the past. Now let's bring it all together. Think of these three matrices like a camera angles of the same movie. GDP, the big picture. It tells you how big is the economy overall. CPI is the pressure. Are price squeezing consumers and forcing rate changes? PMI's early signals. What are businesses seeing before everyone else? Investors don't just look at one, they look at all three together. Strong GDP, controlled CPI, and rising PMI, usually a positive environment. Weak GDP, high CPI, and falling PMI, usually a warning sign and a possible slowdown. And remember, none of this is about predicting tomorrow's stock price. It's about understanding the environment your money lives in. That's how investors move from guessing to making more informed decisions. I hope this helps make things clearer. And if you enjoy this type of simple breakdowns, I do share more on finance and productivity. And if you enjoy this type of content, please hit subscribe and follow me on this channel. See you in the next one.